Hi, my name is Garrett Goggin with SilverStock Analyst. Today we have Chris Ritchie, President, SilverCrest Metals, joining us today. Hey Chris, thanks for joining us.
Thanks, Garrett. Thanks for having me.
I just wanted to, it's been an interesting market, silver market so far this year. A lot of people are becoming interested with the rise in the silver price, the amount of stimulus being pumped in the sector. We've been following you for some time. We've liked the way that you've conducted your business, and we just wanted to catch up with you and hear your thoughts about the Las Chispas project. One of the things that happened recently, you just had a decent sized raise. It was about $72 million. Sprott took down some of that money. How did that come about? Was Sprott interested in getting a large placement, or?
Sure. So basically, we raised 125 million Canadian, and included within that amount, Eric Sprott was about $25 million Canadian. The other portion of that were very long-term holders that are sort of looking out a few years, looking to the cash flow and whatnot. Subsequently, we also had another large trade. SSR Mining historically was a strategic investor. They'd been sort of trimming out of the stock over the last little while. I think now we have a reason why. They just merged with Alistair Gold in a transaction. They also sold the balance of their strategic position, which was 9 million shares, and Eric Sprott took down over 5 million shares of that block. So, and he's purchased a little over 8 million shares in the last 2 months or so. And again, his big push here is silver is going a lot higher in his mind. So again, good to have a really strong long-term investor there, and really good to have, in the neighborhood of 165 million US on the balance sheet now.
Now, that brings you close to being fully financed to build the mill, right?
Yeah, pretty close. I mean, some high-level numbers that we'll talk about are, in the PEA, we referenced about 100 million US for the CapEx. We've made some pretty significant changes to the mill and the plant design. So we're guessing that the CapEx is going to be roughly about 125 million now, give or take. We'll see those numbers in the fees. In addition to that, you need about 25 million of working capital. And again, what that's used for is making sure you have enough cash in your back pocket while you ramp up the mine to make sure you can stay afloat. We'll have about 5 million US in G&A per year. So make that 2 years, you're about 10. So that's about 160 of 165. So two little caveats to that. We don't know the exact start date yet. So hypothetically, we can choose January 1. The fees is going to be in Q4. So we'll spend some money between now and then. We're not sure how much. And drilling. We want to be drilling as aggressively as we can. So if you wanted to ballpark somewhere between 30 and 50 million US dollars as an additional amount of capital required to be fully financed to build, working capital, drill, G&A, that's probably a safe number to use. And in the context of our market cap and what we've raised so far, that would be roughly about 5% dilution if we raise that with equity. So we can do that with a little debt. We can do it with equity. But I think the big point there is that there's no big financing overhang on the stock anymore.
With SSR gone, that was one of the big overhangs, and that just got taken down. And one of the beautiful things, following you guys for some time, is all your deals have been basically at higher prices at no dilution. Sometimes at higher prices than where they closed at the market price the day before. They've been, you've been building value the whole way.
Yeah, one of the numbers we're extremely proud about is how much we've spent on the property. We've spent a little over about 110 million on the property, and with our market cap where it's at, we've added probably $8, $9, $10 of value for every dollar we've spent. So again, in the resource space, that's a pretty significant detail. And again, you're correct. I mean, we've raised money at 105, 210, 373, 585, 728, and 750. To your point about SSR's block and being an overhang, that was a zero discount trade of 9 million shares, and the stock went from $10 to over 12 Canadian in a heartbeat. So again, I think people have been looking at our financings as ways to make money, as opposed to being sort of a zero-sum game between investors and management. We very much want everybody to make money along the way.
And you've done a good job at that so far. So recently, due to COVID, you've been shut down for a while. Mexico shut down mines, declared them non-essential, but then changed their mind, 2 weeks ago? And now mine's essential, and now you're getting back to work, right?
Yeah, I mean, there's a couple of things to note about Mexico itself. About 50% of the population live below the poverty line. About less than 20% of the population pay tax. So you're in a rock and a hard place between balancing health and safety versus getting the economy back and running. So what we're doing right now is we have set up a quarantine camp. So we tested our employees. When you get a negative test result, you immediately transport them to site. They're living on site for 30 days, so nothing going in and out other than food. And even the food's washed extensively and whatnot. So from a health and safety perspective, we've got about 120 people back on site that are safe and sound. We're probably going to wait until mid-June until we would start to introduce people from outside the community, or we're going to expand the size of our quarantine camp. Again, one of the big risks is we don't want people coming in and out into the local community that we're very happy to be guests in, and introduce that risk. So yes, Mexico has deemed mining essential because they need the tax dollars and the support and whatnot. We're going to move in a staged approach to make sure that health and safety stays a priority. So what this means right now is we have about 7 drill rigs running, focused on just finishing up some of the infill drilling. And then come July 1, we're going to be back to sort of aggressive grassroots exploration. And then if and when we can get a bigger group back to site safely, that's when we can get back to work on developing the site, underground development towards a construction decision in the hopefully short order.
Okay. And the fact that you are, still exploring, building towards it, it's not like you're in production. So it's a, little setback, not a tremendous setback. The next big step for you guys would be your feasibility with that first quarter of 2021?
Late Q4 this year, and I think you nailed it in terms of, we have a lot of operational flexibility. We have no debt, no committed capital. If we need to slow down for health and safety, we have that flexibility. Some of the challenges of the producers right now is losing productivity by having these protocols in place, so they're not able to capture the same amount of margin expansion as you think, and also servicing debt and some of the other pressures that they have. So like I said, we have a hypothetical Jan 1 start date, but we really don't know. We don't know what the global supply chain is going to look like. We don't know what the safety issues are going to look like. But again, very fortunate that we're in command of our own timeline, again, to prioritize the health and safety of our employees and our community.
That sounds good. What major changes, improvements are we going to see in the feasibility versus the pre-feasibility? What are you guys working on?
Yeah, and I think firstly it's really important to note our strategy, and the strategy has always been to get into production as quickly as humanly possible for the smallest amount of capital possible, and then as we're building, producing, you've got a dual path of continuing to grow your resources. So the big work in the last year was to do extensive infill drilling to make sure that you confirm and add confidence to the ounces that we did delineate in that PEA, which is now a year old. That was May 2019. So, from an expectation standpoint, we're not trying to say that we've grown dramatically. I think what we've said is added a lot of confidence. But what we are hoping to see is some improvement to grade. So in the PEA, our average grade on a silver equivalent basis for the first 4 years was roughly a kilo.
Yeah, how can you improve on that?
I mean, roughly, if you had 350 grams a ton, that would be top 25 or 30 in the world. So we don't need to, but we've been fortunate enough to have 3 major discoveries in the last 7 or 8 months that have all been publicly released, where the average grade on an uncut, undiluted basis is approximately 3 kilos. So we'll see what that grade turns out to be when we do that cut and diluted, those numbers have been done. But if you wanted to cut it in half, just as a placeholder, again, these are just back of the napkin numbers. We have, something that would be close to 50% higher grade, all very much near the front end of the mine life. So the big changes that we're hoping to make are being able to be a little more aggressive with how we would sequence that high grade in the early days.
You don't even need a smelter for that.
Take some of the lower grade out, add some of the higher grade in. You might be able to see a boost in production, slightly lower cost, which all might contribute to some benefits in the free cash flow profile based on increased ounces. Again, a to be seen, the specifics on those numbers, but again, very significant increase in grade so far in the drill bit.
Do you even have to? Do you have to even process that? Why don't you just ship it right to the smelter?
Well, one of the challenges, we talked about the increase in the capital going from a 1 to 125. One of the interesting things about silver is the higher the grade, you have challenges to keep your recoveries up. For people that remember, about 3 months ago, we put out a press release with increased recoveries. We have readjusted the mill to be able to handle up to 1.8 kilos of silver equivalent on a daily basis. Anything above that, we're at risk of actually decreasing the recoveries. So that's one of our challenges, sequence the mill as aggressively as we can without risking how much of the silver we're actually recovering on a daily basis. So again, those are the definitions of champagne problems. But for us, just making sure we're optimizing as aggressively as we can, but still being conservative. And if we don't make those ounces and tons into the front end of the mine life and they're slightly delayed into year 2, year 3, all that means is that grade and those ounces are going to be very much in the first 1, 2, 3, 4, 5, 6 years. So that's going to be the challenge with the feasibility study, is that we have no incentive to be overly aggressive with that study. We have every incentive to have a production profile that beats the feasibility study. Again, given that we've raised the bulk of our money and that we're trying to be good long-term partners with our shareholders.
What about growing ounces? Your first study, it's got about 100 I just updated it for 1,800 gold and $18 an ounce silver. So like 120 million ounces. And then in your pre-feasibility, the production dropped pretty steeply after, year 3. Are you going to be able to add ounces and fill that gap, basically?
Yeah, so in the PEA that came out last May, we had 88 million ounces included in that original study. Then we had an additional 20 million ounces that were not in that mine plan. So I think, conservatively, we're thinking in the neighborhood of 95, 100 million ounces will make it into that mine plan. That's one of the challenges with going from a PEA to a feasibility study. You don't convert all those tons, so some will get left out. Now, in addition to that, we've made new discoveries. So you're subtracting some, you're adding others. So if we made it to roughly, like I said, 95 to 100 million reserve ounces, and then maybe we're getting to 125, 130 on a resource base, we'd be very happy with that. I think one of the other main numbers to note would be that our current mill is planned to be built for 1,250 tons per day. So if you do the math on that times 365 days per year, we need roughly 450,000 tons to fill that mill on an annual basis. So we're hoping to get to approximately 4 million tons in that feasibility study. So roughly about 9 years of mine life. So again, if the grade holds up or hopefully improves, we can front end load more of that high grade. You've got a nice robust 7, 8, 9 year mine plan. And the key here again is we only had 10 veins of a known 42 veins included in that PEA. So a big part of the math that people will need to do some work on and get their heads wrapped around is if we were to get to 6 million tons over time, hard to know exactly what grade that comes in at or how many ounces those would be contained within those tons. but you could get to roughly a 10-year mine life at 1750 tons a day. So again, if you remember the Santa Elena story, which was the previous SilverCrest, which is only 25 kilometers down the road, they grew the resources roughly 3 times post-production. So the fact that we would have a mill up and running, for us to be able to increase the throughput would be very minimal CapEx, maybe approximately $20 million. So part of our story here is getting some degree of visibility on what could we do in terms of tonnage increases over the next 2, 4, 6 years. Because if the grade holds up, the tonnage increases, and we're fortunate enough to be able to increase the throughput, you can have a situation where come year 5, 6, 7, 8, you could have more throughput at a similar grade maybe and be producing more ounces. So again, that call option strategy of ours for, again, very minimal capital, and at that point, very low risk if you're up and running, is something we want to make sure people are well aware of.
Right. Yeah, you can definitely bump that mill up for very small capital once you have those ounces. To be honest with you, I followed SilverCrest mining very closely, and that was always a cash cow. That's why First Majestic liked it. But you know what? It always sold at a discount to its peers based off free cash. And I think it was because of, your strategy to, you didn't get ahead of yourself. You know what I mean? You're not going to spend money drilling for a huge resource. You'd rather get into production, prove out the cash, and then get another year or two ahead of you. But I think that held SilverCrest mining back a little bit.
Yeah, and I think part of it was you're a single asset company. We never really had critical mass. And in today's day and age, people need to have size and scale to get on the radar. For us, we will be drilling very aggressively here because for us, again, the visibility of us to get to that 6 million tons could allow for a very significant economies of scale and production increase. And the key difference here is we want to do that with cash flow. Again, if we go back to how efficient we've been with our shareholders' capital, we wanted to dilute our shareholders as little as humanly possible to get to that production. And so we can get far more aggressive with cash flow. One of the other strategies that fits into that would also be maybe we can get lucky and find a satellite property nearby. And if that's something that proves out to be 500,000 tons, 1 million tons, 2 million tons, 4 million tons, it could be something hopefully that we would truck down the road and again give further visibility to some scale at smaller capital. But I think the point here is maintain that capital efficiency and really, really protect that dilution, as you referenced, as much as humanly possible. But we will be very aggressive trying to build out the tons here.
Right, that's good. No, I've referred to it before. You guys have done a great job at that. I cover like 25 silver companies, and probably 20 of them are not good stewards of capital. They dilute shareholders basically every year to pay their management salaries. They don't make any money. They're not good investments. They don't create accretive growth. But, you guys have done a really good job at that, growing accretively and not diluting shareholders. And no doubt you'll be able to continue that going forward. And one of the reasons why, SilverCrest and Las Chispas is so enticing is, the grade. One thing to note for like the layperson, not the mining engineer or geo, is that, grade is the most highly correlated thing to low costs. You mine a ton of ore, you get a lot of ounces out of it. Ounces is the denominator in the cost equation. So, SilverCrest represents a good opportunity in a rising market, and it also gives you defense on when the market declines because their margins are so wide. They're going to be producing, at what, about $6 an ounce, hopefully, based off your pre-fees?
Yeah, in the PEA, we had roughly $4.86 for silver equivalent ounce. And again, we're roughly 50-50. So if you wanted to put that on a gold equivalent basis, that's less than $370 on a gold equivalent basis for an all-in sustaining cost.
Wow.
So again, this is one of the unique things as well is we don't exactly know where the gold and silver price is going to go. We might, I think we all are to a certain extent we know what's happening with the stimulus and whatnot. But if silver does kind of have a pullback, we have a business model that can be sustained at far lower silver prices. So for investors getting into the space right now, if you look at some of the charts and the performance of the sector, you could look at it and say, wow, those are intimidating charts to buy today. If you look at it in context with how big the sector could move, we're still in inning number one. But again, from a risk management perspective, we're one of the cheapest names if you believe silver takes a breather and gold pulls back for a little while. Because again, our margins hold up, to your point, very dramatically. I mean, if you're seeing material that's roughly 2 kilos, that stuff's going to be roughly 80% plus margin. And to give you a reference point, we have over 500 drill intercepts over a kilo, and we have over 50 drill intercepts over 10 kilos. So again, another way to put this, our finding cost per ounce in that PEA that's now a year old was 28 cents. Now, again, that number goes higher as you convert resources to reserves. So, comfortably use 2-3x there if you like. But if you can find it for 50 cents, 60 cents, $1, and your all-in costs are roughly $5, and with silver at over 17 today and you're making $12 of margin, that just gives you a flavor of how we can hopefully grow value as we drill aggressively, again, simultaneously as we're trying to get to cash flow.
Right. I like how you throw in that statistic, 28 cents per finding an ounce of, silver equivalent. The mining companies, when they report all-in sustaining costs, it doesn't include the exploration or what they paid to get that asset. And a lot of miners, they'll pay a lot for an asset, and then they'll make a little bit money managing the asset. But if you include that front end spend, they didn't make any money. It's not a profitable project. But SilverCrest only spent $28 to find their ounces. So you can add that onto the all-in sustaining, and that will give you an all-in cost, right? To figure out all the invested capital and the return that you're making on that.
Well, that's that number. We've spent about $111 million to date on the property.
Yeah.
And you can compare that to the market cap today in terms of that capital efficiency. And again, that's important to us. I mean, all of the senior management have for me, it's roughly 85% of my net worth is in the company. So again, we're all heavily invested. We're very significantly aligned with our shareholder base, and we want to keep it that way.
Right. I agree. It's really good to see. A lot of companies, management, they own very little, if any, shares in their company. The reason they work there is to make their salaries. They're not invested in the stock. They're not aligned with shareholders' interest. But Eric Fear, the CEO, right? He's had a long history of building accretive projects. How many projects has he done already?
He's built 6.
Okay.
This is number 7.
Okay.
And again, you can go back to the analogy of Santa Elena. That was a roughly $5 million purchase price for the asset itself. He drilled it off. He got all the permits. He built it, operated it for 5 years, sold that to First Majestic. And now that's one of the cornerstone assets for them. So again, this is a project right down the road. Paid approximately $5 million for this asset and taking it to where it is today. So the model, again, is very efficient with shareholder capital, and try to grow through grassroots exploration, boots on the ground management, and then really rolling up your sleeves and trying to really get to that cash flow as quickly as we can. While saving the shareholders that dilution.
Nice. That's impressive and easier said than done, right? You need to find the right project in order to do that.
Well, the grade does a lot of talking. So yeah, we're very fortunate. There's a lot of other people doing great work, and it's just without the same grade to carry the day for them.
And speaking regarding that, Eric's done a great job too, right? Because he was able to realize that this little project contained value, and therefore held it back from the First Majestic transaction.
Yeah, and I mean, that was part of it in that this was a historically producing asset, 1880 to 1930, and the average grade back in the day was 3 kilos silver equivalent. I mean, they have a cutoff grade of 1 kilo. So we have journals and diaries and technical reports. So again, I'll go back to the point that our first drill hole was 2016. and we had one drill rig that year. And we had no roads, we're just getting permits. We're starting to understand the property. So to go from early 2016 to put out that PEA in May of 2019, so that's how you get that roughly 88 million ounces in the PEA, the 108 million ounces as a total resource. Again, what do we get to in the next 3, 4, 5, 6 years? Now that we've got a better understanding of the property, some more capital behind us, we can drill more aggressively. So again, understanding that this still is a resource growth story at the same time as we're moving towards cash flow is, again, a very unique strategy. So that's why we keep referencing that ability to grow the mine life, but hopefully to be in a position to grow that throughput. If we don't get there, we don't get there. That's okay. The mine life's already robust enough. But that option value of getting to 1,500 tons a day, 1,750, 2,000, again, all comes with very small incremental capital, post-production, given where we're at. So again, from a risk-reward perspective, we can manage the downside a lot better than our peers given our margin profile, and our valuation looks better and better on a relative basis if and when silver and gold weakens. But we all know if gold and silver go higher, the fund flows are going to come into the space, and we're successful with the drill bit. We'll get the free cash flow growth. We'll get the resource growth, hopefully, the throughput growth, and then obviously M&A is something that we're seeing more and more of these days. So between now and the fact that we might make that production decision around the end of the year, if and when anyone wants to have a conversation, that's probably a reasonable time frame. If not, we're more than happy to put this into production and get that re-rate that usually happens post a successful build time.
Yeah, like the whole re-rate thing, a couple of the miners that I follow, they're coming to, like Fortuna Mining's coming into production at Lindero, going to do, 150,000 ounces of gold in 2021. And that company's selling at a significant discount. And I think the reason why is because, investors have been burned by the sector before, and they don't believe the management, and they wait until the miner to go into production for the revenue to sink to the bottom line before they start bidding up the stock price. But you guys have had such a great, strong track record and history that people believe you, that you're going to achieve what you say you're going to achieve. So I don't see that the discount is as great for you guys as it is with some of the other guys. But no doubt there's a small discount. I'll
say one thing, Garrett, there is typically getting into production sometimes is quite timely, meaning sometimes it makes 3, 4, 5 years.
Yeah.
Our construction timeframe's conceptually about 15 months.
Yeah.
So you're not waiting that long.
Wow.
We already have, the majority or the heavy majority of that financing in place. That's also one of the other risks.
Yeah.
Permits are already in place. That's one of the other risks that tend to hold it back. So again, and then quite often they're not drilling simultaneously trying to build that resource and adding to the growth story.
Mm-hmm.
So again, those are major differences that we're employing in our strategy that can still give re-rate opportunity to the upside while we're going through that construction period that differentiates us.
Right. Yep, you guys definitely stand apart. I guess the only thing that I kind of want to ask you about, one of the things, so your pre-feasibility looked great, high IRR, great NAV. When you get into mining, do you think that you're going to run into issues with the narrow widths and the high grade, or are you going to be able, are the widths going to expand as you're able to prove out the resource?
Yeah, and that's, again, one of the other adjustments we're going to make in the feasibility study. So the year one is something we're probably going to ratchet down that year one expectation of ounces because the ore that's already sitting on the ground historically is lower grade, and we're already mining right now. But in the early days, you're kind of learning how to mine. You're learning how to manage that dilution, right? To your point, you're okay. We did reference the roughly 3 kilos was the average uncut, undiluted grade of those new discoveries that we've made since the PEA. And I took a back of the napkin number and said maybe cut it in half. So again, that's a good example of something we still have to do work on that will, maybe it's more than half, maybe it's less than half. So we'll see how exactly those numbers pan out. So it's still looking like when you're finding 3 kilos uncut, undiluted, you can work with that material pretty aggressively.
Yeah.
So it is a to be determined. It is definitely a to be determined to see how they hold up. But a lot of these veins are averaging over a meter wide.
Okay.
I mean, this is not unique in the mining space.
Okay.
From a technical standpoint. It might take us some time to learn to mine it efficiently like all mines do. And again, that's another reason why, again, for us to be conservative with our feasibility study metrics, just to make sure we set the bar at a reasonable level so that we can kind of meet or beat those levels. But that is definitely something we will be trying to manage.
Correct. And, that was the thing that was impressive about your pre-feasibility study is that it was so your estimates that you had high grade, mid grade, and low grade resource, right? And you basically use most of the low grade and mid grade, didn't use the high grade?
Well, we had, I mean, again, here's one of the champagne problems, is the cutoff grade that the historic miners used was a kilo. So anything that was below a kilo back in the day was left behind. We're fortunate enough to have roughly 175,000 tons of roughly 225 grams per ton material sitting on the ground already. So it's lower margin, but there's no cost associated with it. So in the first year of mining, we're hoping to use some of that or all of that with new ore that we're already stockpiling on the ground today. Well, as we get back to work, to sort of iron out the wrinkles of the mill. And once we get things humming and get it to where we want it to be, then we can more efficiently throw in more of the high grade so we're getting full value for it. So again, it's just ramping up accordingly and making sure we're not wasting the high grade through the mill until we know it's working appropriately.
Right. Okay. Yep. That's smart. And I don't know. I guess one other thing there, we covered a lot, but fund flows. You mentioned fund flows. SilverCrest, you're going to be added to the TSX index, right? And then based off your SSR stake, your percent, your float goes higher. So GDXJ has to add more also, right?
Yeah, I mean, right now we've seen about 10 years in a row of outflows in the precious metal space. It's not been a pretty place to be for quite some time. Everything else has been working. There's a couple interesting charts out there showing that the commodity sector as a whole has not been cheaper to the broader market, to the S&P, in 50 years. So, I mean, everything is about context. If you look at the charts in the last few months, we've seen the sector have a really nice rally. If we look at where the gold miners and silver miners are relative to the last time we had a cycle, this looks like it's the first inning. So yes, if you start to see performance increasing, more people need to have access to the space. And right now, what you're seeing is approximately 12-13% of the Toronto Stock Exchange is in the gold mining sector, but approximately 5% of the funds have weighting. So if and when gold goes higher, the pressure for more people to increase their exposure to the space happens. And this space is tiny. I mean, I think the cumulative market cap for the entire precious metal sector is about 40% of Microsoft alone. So again, it will not take much fund flow to move the needle extensively. So we're very much into a situation where positive fund flow can just create a positive feedback loop that can push these things higher, all while the higher commodity price continues to make valuations look more reasonable or hopefully cheap.
Right. Yep. I agree. Very early stage, first inning, basically only 5% of the way there. No one's invested in the sector. You get some of that money coming in, and it's going to be fuel to the fire. So, is there anything else?
That's part of it. With again, we've got the defense so that our margins hold up if it doesn't happen. But a lot of ways in which we can participate on the upside with the drill bit, execution, free cash flow, hopefully increased throughput. And the commodity price.
Yeah, no doubt. Absolutely. Thank you, Chris Ritchie, for joining us here today. And we'll be following you closely, and we'll talk to you soon.